What is a reasonable salary for an S corporation to pay a shareholder? This is a fun one. Actually, I have all the cases rolling around here. So here's how it works with an S corp, and this is why it's important. If I make $100,000 as a sole proprietor, I am paying old age, death, and survivors of 12.4% and Medicare of 2.9% on all of that income. I have a phase out at around $120,000 on the old age, death, and survivors, but the Medicare sticks around. In English, when we break down the math, it means that I'm paying roughly, they say 15.3, but there's a little bit of a deduction you get on a portion of it. I'm paying 14.1% on every dollar just for Social Security up to about $120,000. So if I make $100,000 as a sole proprietor, I am paying $14,100 in tax just on Social Security. That's why they call it the self-employment tax. If I was an S corp and I took all that money and I just received a distribution out of the company, technically I would pay zero on the self-employment tax. Now the problem is,
I feel but.
Yeah, you get a but. You have to take a reasonable salary if you participate in the business. Now, if you are a completely passive owner, there are cases where you don't have to take a salary. But the IRS kind of looks at you funny saying, why are you an S corporation owner and you don't do anything with it? But you're supposed to take a reasonable salary. And the reasonable salary would be subject to the self-employment tax. So what it really breaks down to, and what we use as a rule of thumb, is that you're supposed to be paid a reasonable salary. And there's all these tests that the IRS likes to use. There's cases, what do they say? The performance, the salary comparison, company conditions. They actually put out a fact sheet that says the employee qualifications, the scope of the work, the size and complexity, prevailing general economic, like I'm not even going to go into these. Know that the rule of thumb is you're pretty safe if you're paying about a third. And to make this point, there was 3 cases that the IRS brought where companies were paying zero in wages. And the guys, the company owners, 2 of them were CPAs, and one of them was a real estate agent. Can you believe it? CPAs pushing the law. They were paying zero in self-employment tax, taking out $240,000 to $250,000 a year as their distribution. So they were getting the money without paying the tax. And the IRS said no way, and they forced them to take a reasonable salary. And the reasonable salary ended up being about $90,000. So what we always say is about a third. That's about right. Mm-hmm. So none of the cases were people that were actually paying themselves a reasonable salary already. One of them had an earmark. They were going to pay themselves $24,000 out of the $250,000 they were making. And they said, but really, we were going to do it. And you say, one third of what? Of net income. Sorry, I need to be clear. You pay yourself about 1/3 of the profit. So if you don't pay yourself a salary, you should have paid yourself about 1/3 of the profit. So the trick is to say 1/3 of when you add in your salary and the net profit of the company, you add those 2 together, your salary should be somewhere in the 1/3 range. It can change if you're making a lot of money, then you just have to pay yourself a reasonable salary, which we would actually look and we would say, all right, how much does somebody with my experience and what I'm doing actually make? If you were in a company that had a bunch of employees, like I could justify paying you a little bit less. But in the case, there was, actually I'll pull the case because you guys may want to check it out. It's always fun. Here we go, yeah. The 8th Circuit, it was 2012 Watson versus Commissioner, so you always know that. The S Corporation shareholder employee was paying himself only $24,000 of salary while withdrawing over $375,000 in distributions. Which was funny is he actually never paid himself the $24,000. He just said, hey, I was going to pay myself the $24,000. Well, the court went and said the annual reasonable compensation amount was $93,000. In this case, the guy was a CPA. He was the sole shareholder and employee of the S Corporation. So just to give you an idea, that was, what would that be, about $400,000 of total income? Actually, it was $375,000, so $90,000. That's not even he was even about 25%, so they actually let him take less.
So if I'm an S corporation owner and I don't have a profit, I obviously don't have to pay myself a salary, correct?
Correct.
What if I don't take any distributions or pull any money out?
Then technically the rule, and you asked a really good question, that stumps most accountants. If you are not taking distributions out of your S corp, technically you don't have to take a salary. So if my company makes $200,000, but I don't take it, technically I don't have to take a salary. But you're going to hear us say, hey, let's not get audited for that, because you can be right, but there's something being called dead right. I don't want to go through an audit. So other questions, what if you are not making a profit? Then you do not have to take a salary. If a husband and wife own the S Corp, do they both need to take a salary? John, technically, no. It depends on what they're doing. So if you are truly passive, you don't have to take a salary. So there is a case on point where the guy was literally doing nothing for the S Corp. He was just an owner, and he does not have to take a salary, but he better be pretty passive. So if like you and your spouse are both actively involved, then you really should be both taking a salary. But that's where you do a 401k and you push a bunch of money into your retirement plan. And if you're making too much money, you do a DB plan and you put, sometimes $100,000, $200,000, $300,000 a year into a retirement plan. So there's always a remedy. We always look at it. We're going to get the most out of it. Boy, we have a lot of questions coming in. You guys are just hammering me. Let's see. What if husband and wife for full time, it's commensurate with whatever you're doing. So if you're spending 10 hours a week, in the case of the accountant, it was $40 an hour is what they said, hey, you got to make. So let's say you're doing 10 hours a week and you worked for 50 weeks. That's about $20,000 a year. Do your math in your head. That's if you're doing a professional service. So you could actually take less. At the end of the day, what we care about is that we're taking something in salary and keeping them off our back. Because the one thing that you notice about all the audits is they didn't take a salary. So the trick in an S Corp, which runs at about a 0.3%, 0.03% actually, less than a third of a percentage chance of being audited. The ones that do get audited are the ones that don't take a salary. So take a salary, and then you don't have to worry about it. Here we have a bunch of some people are asking for examples on this. Let's see. Oh boy, we have so many questions. You know what I'm going to do is I'm going to bust through and we'll come back to these because we are just getting hammered with questions and they're all over the place. So let's go back. So again, S Corp, take a reasonable salary, about 1/3 of the net income plus whatever salaries you're taking. So if you're taking a $20,000 salary but you're making 200, you add them up together, 220, divide it by 3. That'll give you a good place to start. Although technically we would just say, hey, what would be commensurate for something along those lines? Again, pigs get fat, hogs get slaughtered. Pay yourself something.